Welcome to the Deep Dive. We're the show that cuts through the noise, digs into the data, and really tries to pull out the crucial insights you need.
To make sense of it all.
Exactly. And today, we're tackling something pretty heavy, something that really hits home for your financial well-being, the UX market right now, and the very real risks of a significant downturn. We've gone through a lot of comprehensive market risk analysis from various sources, and we've distilled it down to this headline number, a U.S. market crash probability score of 6.5 out of 10.
Right. And before you panic at that number.
Let's unpack it. It doesn't mean a crash is definite tomorrow. What it does signify is a significantly elevated risk. We're talking about a major market downturn, maybe something exceeding 20% sometime in the next, say, 12 to 18 months.
And look, this isn't about scaring people. It's about understanding the landscape.
Absolutely. It's about being informed, having clarity so you can navigate this with, confidence.
Precisely.
Yeah.
Because it's complex.
Yeah.
Right? This 6.5 isn't just pulled out of thin air. It's a weighted aggregate score looking at 10 different risk categories.
10 distinct categories.
Yeah, and it paints a picture that's, it's precarious. What's really interesting, or maybe concerning, is the divergence.
Yeah.
You got, employment data looking pretty resilient on the surface.
Which usually signals stability.
Usually. But then it's standing against this whole array of leading indicators that are practically screaming caution. So our goal today is to help you understand why those signals are so strong.
And what they might actually mean for your investments down the line.
Exactly.
Okay, so where are the biggest warning signs? Our analysis points to 3 really critical areas driving that 6.5 score. Let's start with valuations. What's the market telling us about value? Or maybe overvalue?
Yeah, extreme valuations. That's the first big one. And there are 2 key indicators everyone's watching. First, the Buffett Indicator.
Right, explain that one quickly.
Sure. It basically takes the total market cap of all U.S. stocks and compares it to the country's GDP, the gross domestic product. It's like, how much is the market worth compared to the size of the whole economy?
And where is it now?
It's currently at an unprecedented 200%.
200%, wow.
Yeah. That puts it deep into what analysts call strongly overvalued territory. And here's the kicker. This level, it's only been breached twice before.
Okay, when?
Right at the peak of the dot-com bubble in 2000. And then again, just before the 2022 bear market kicked off back in late 2021.
So not exactly comforting precedents.
Not at all. And Warren Buffett himself, famously said a ratio getting close to 200% is like playing with fire. It suggests the market's priced for perfection, maybe growth that just won't happen.
Setting up a potential fall.
Potentially, yes. It leaves very little room for error.
And there's another valuation measure flashing red too, right? The Shiller P ratio.
That's right. It tells a very similar kind of unsettling story. CAPE EP stands for Cyclically Adjusted Price to Earnings. It smooths out earnings over 10 years, giving a longer-term view on valuation.
Less volatile than standard PE.
Exactly. And right now it's sitting at 37.81.
Which is high.
It's more than double the historical average, which is around 17.
Double, okay. And historically?
The only times it's been higher were just before the 1929 crash and, again, the 2000 dot-com bubble.
Wow. That's some serious historical company. So are there any arguments for why this time might be different? Why these high numbers aren't as scary as they look?
That's the key question, isn't it? And yeah, there are counter-arguments. Some point to, persistently low interest rates for a long time, though that's changing.
Right.
Others talk about the globalization of U.S. companies, meaning more earnings come from overseas, potentially justifying a higher ratio relative to U.S. GDP.
Okay.
And then there are technical arguments about changes in accounting rules or the impact of share buybacks affecting the E and PE ratios.
So factors that might inflate the ratios compared to the past.
Possibly. But the underlying point remains. Valuations, this high demand, almost perfect execution, and really strong, sustained growth. The margin for error is just razor thin.
Okay, so valuations are screaming caution. Let's move to the second major signal set, traditional recession signals. You mentioned the economic thermometer.
Indeed. Think of the yield curve like a thermometer for the economy. Normally, you get paid more interest for lending money longer term. Makes sense.
Sure, locks up your money longer.
Exactly. But when short-term interest rates go higher than long-term rates, that's what we call yield curve inversion aversion. It's an anomaly. And historically, it's been an incredibly reliable predictor of a recession coming down the pike.
And where are we now with that? I know it was inverted for a long time.
It was, historically long. The key spread, the 10-year versus the 2-year Treasury yield, was inverted from mid-2022 all the way to December 2024. Now it's actually positive again, around 0.54%.
So it uninverted. That's good, right?
Well, here's the tricky part. Another key spread, the 10-year versus the 3-month yield, is still negative at -0.12%. But more importantly, there's this thing our sources call the Un-Inversion Trap.
The trap. What's that?
It's counterintuitive, but recessions often don't start during the inversion. They tend to begin after the curve uninverts.
Really?
Yeah. If you look at the last 4 cycles, the recession started, on average, about 6 months after that 10-year, 2-year curve flipped back to positive.
6 months after. So based on the timing.
On that timing, it puts the U.S. economy right now squarely in the highest probability window for a recession to potentially start sometime in mid to late 2025.
Wow. So the all-clear signal might actually be the real warning bell.
In a sense, yes. And it's not just the yield curve. There's also the leading economic index, the LEI.
What does that track?
It's a composite index, pulls together 10 different economic variables, things like manufacturing orders, building permits, jobless claims, stock prices, consumer sentiment. It's designed to predict peaks in the business cycle about 7 months out.
Like an early warning system.
Exactly. And its current trend is, well, it's concerning. It fell again in June 2025 by 0.3%. It actually contracted 2.8% over the first half of 2025.
So it's declining consistently.
Yes, and importantly, the LEI has now officially triggered a recession signal for the 3rd month in a row. Its 6-month annualized decline is now negative 5.6%. Historically, when this index turns down this decisively, a contraction usually follows.
Okay, yield curve trap, LEI flashing red. But then there's something weird happening in the bond market, right? The complacency anomaly.
Yeah, this one is really puzzling. We're talking about credit spreads. Think of these as the extra interest or yield investors demand to hold riskier corporate bonds compared to super safe U.S. Treasuries. It's kind of a market fear gauge for corporate debt.
And they're low.
Oh, exceptionally low, really tight. The main index for high yield, or chunk, bonds, the BofA U.S. High Yield Index, OAS, is sitting around 2.86%.
And the averages?
The long-term average is way up at 5.25%, so spreads are dramatically below average.
So all these other indicators are warning of recession, but the market for risky company debt seems unfazed. It doesn't add up.
It really doesn't. The bond market, often called the smart money, seems to be ignoring these alarms. Is it deep-seated complacency? Are they betting the Fed will bail things out? Or do they see something else?
Whatever the reason, it seems risky.
It implies a potential for a really sudden, violent repricing if or when sentiment shifts or the economic data gets worse. It's like a coiled spring.
Okay, that brings us to the third major risk category, policy risks. Government actions, basically. Fiscal and monetary.
Exactly. Let's start with fiscal policy, government spending, and debt. The U.S. federal debt-to-GDP ratio is, well, it's alarming. It hit 120.9% in the first quarter of 2025.
120.9%. That sounds incredibly high.
It is. Historically, you see levels like that during major wars, not during periods of relatively low unemployment like we have now.
Yeah.
And the projections, they see it hitting 156% by 2055 if things don't change.
And the deficit, the yearly shortfall.
Also huge. Projected at $1.9 trillion for fiscal 2025. That's 6.2% of GDP. Again, highly unusual when unemployment is low.
Which raises concerns about a potential fiscal spiral.
That's the worry. You get into this loop. More debt means higher interest payments, which makes the deficit bigger, which means you have to borrow even more. It's a tough cycle to escape and creates long-term instability.
Okay, that's fiscal. What about monetary policy? The Fed?
Well, the Fed is still doing quantitative tightening, or QT. They're shrinking their balance sheet, effectively pulling money out of the financial system, reducing liquidity.
Tightening the screws.
Right. And on top of that, real interest rates, it's the interest rate minus inflation, are now firmly positive. They're in restrictive territory. Money isn't cheap anymore. Borrowing costs are actively putting the brakes on economic activity.
And then there's the political side of things.
Absolutely. Political uncertainty. The economic policy uncertainty, or EPU index, shot up to 328.78 in July 2025. That's really high.
Driven by?
Mostly by talk around new tariffs and, of course, the run-up to the presidential election. Uncertainty makes businesses and consumers hesitant.
Is there any historical pattern with election years?
Interestingly, yes. Since 1952, the S&P 500 has never declined during a presidential re-election year.
Yeah, or will.
But the current level of political polarization is pretty extreme. So some sources argue those historical patterns might not hold this time. The unique risks today could override that tendency.
Okay, so those are the big three: valuations, recession signals, policy risks. But there are other factors too, right? What else did the analysis highlight?
Yeah, definitely other significant risks. One is AI and technology disruption, but maybe not in the way you'd first think.
How so?
It's about market concentration. The Magnificent Seven tech stocks now make up an astonishing 34.1% of the entire S&P 500's market cap.
A third of the index in just 7 stocks.
Basically, yeah. It's nearly triple their share from just 2015. This creates what some call an illusion of a strong market. The index can go up, making things look rosy, even if most other stocks are actually declining.
So poor market breadth. A
Yeah.
classic warning sign.
Exactly. And on AI specifically, there are signs of a potential bubble forming. You've got over $500 billion, $560 billion invested in AI recently,
Huge amounts.
but it's only generated maybe $35 billion in actual incremental revenue so far. That's a massive gap between the investment hype and the current business reality. Valuations seem detached from fundamentals.
Is there a risk the payoff takes longer than expected?
That's the productivity paradox argument. AI could be huge long-term, but history shows big technological shifts often cause an initial dip in productivity, a J-curve, before the gains kick in.
Yeah.
So the payoff everyone's betting on might be years away, leaving today's valuations looking very stretched.
Okay. What about trade and tariffs? You mentioned that uncertainty.
Right. With new tariffs implemented in 2025 under the Trump administration, the average effective U.S. tariff rate is now 18.3%. That's the highest it's been since 1934.
Since the Smoot-Hawley era.
Wow.
And the economic impact.
The sources project these tariffs will shave about 0.5 percentage points off U.S. real GDP growth in both 2025 and 2026. That's a direct drag.
And for consumers. For you listening.
It translates to about a 1.8% increase in the overall price level. That's like an average income loss of $2,400 per household.
Ouch. Can you give examples?
Sure. Things like potentially 40% higher prices on imported shoes, or maybe an extra $500-800 on the price of a new car. It hits your wallet directly.
Definitely a drag on purchasing power. And then there's the housing market, still looking vulnerable.
Very much so. It's an affordability crisis, plain and simple. Buying a medium-priced home, around $440,000, now takes about 44.6% of the typical household's income.
Almost half their income. The benchmark is usually 30%.
Exactly. It's way beyond that sustainable level. And get this. In 47 out of the 50 largest U.S. metro areas, the median earning household cannot afford the medium-priced home.
47 out of 50. That's staggering.
It really is. And this vulnerability extends into commercial real estate, CRE, which is a major risk, especially for banks.
Because of remote work hitting office demand?
Largely, yes. Office vacancy rates are projected to hit 23% in 2025, maybe 24% in 2026. And regional banks are heavily exposed here. They hold a lot of this debt.
And loans are coming due, right?
Over $1 trillion in CRE mortgages are maturing in the coming year. They'll need refinancing, but at much, much higher interest rates than before. That's a recipe for defaults.
Are we seeing defaults rise already?
Yes. The delinquency rate for commercial mortgage-backed securities, or CMBS, is already 7.5% overall. But for the office sector specifically, it's 12.1%.
12% of office loans are already delinquent.
Correct. If that climbs higher, it could really stress the banking system, particularly those smaller regional banks that are so concentrated in CRE lending.
Okay, so that's a lot of risks stacking up. Valuations, recession signals, policy, tech concentration, tariffs, housing, CRE. With all that, what are the potential paths forward? What scenarios are plausible?
Our sources lay out 3 main scenarios with probabilities. The most likely, they reckon, is a soft-ish landing, or maybe a rolling recession, with about a 45% probability.
Soft-ish. Rolling. What does that mean exactly?
It means we avoid a deep, official, across-the-board recession. Instead, different parts of the economy contract at different times. Maybe housing slumped already, manufacturing dips next, but the labor market and services overall hold up reasonably well.
And the stock market in that scenario?
Probably sees a significant correction, maybe 15–20%, as valuations come down and growth slows, but not a full-blown crash. The evidence supporting this is, well, the continued resilience we've seen in jobs and spending, plus the fact the Fed has managed soft landings before, like back in 94, 95.
Okay, scenario 1. Bumpy but not disastrous. What's scenario 2?
Scenario 2 is a moderate recession and a proper bear market. This gets a 40% probability.
So nearly as likely as the soft landing. What happens here?
Here, all those cumulative risks we talked about actually bite. They trigger a formal recession, probably starting sometime in the first half of 2026. Unemployment would likely rise significantly, maybe to the 5.5% to 6.0% range,
And the market.
a sustained bear market. The S&P 500 could decline maybe 25% to 35% from its peak. This scenario aligns strongly with those reliable historical indicators like the yield curve and the LEI. Plus, the direct hit from tariffs, rising delinquencies. It all points towards this being a very real possibility.
Okay. And the third scenario, the least likely.
Right, the systemic crash scenario. This has a 15% probability. It's low probability, but obviously very high impact. Think of it as a tail risk.
What could trigger something like that?
It would likely take a combination of shocks hitting at once. Maybe a major geopolitical crisis happens just as the CRE crisis really explodes, taking down several regional banks. Or perhaps there's a sudden loss of confidence in the U.S. Treasury market because of the debt situation.
A perfect storm.
Essentially. In this worst-case scenario, the S&P 500 could crash over 40%, dragging the global economy into a deep, nasty recession. The ingredients are there. The extreme valuations, the unsustainable debt, some fragility in banking, that market concentration. It makes such an outcome plausible, even if not probable.
It's sobering to think about. Does history offer any guide here, any parallels to past crashes?
History always offers perspective, though never a perfect map. You can definitely see parallels.
Yeah.
To 1929, there's the speculative excess, the leverage, that belief that things can only go up the permanently high plateau.
Okay. What about the dot-com bubble?
Yeah, 2000 feels very relevant today. You had a transformative new technology, the internet then, AI now driving huge investment and speculation. You have extreme market concentration in a few tech darlings. You had sky-high valuations, and you had poor market breadth, just like now.
But you mentioned earlier there's a key difference between the tech giants today and the dot-com startups.
Right. And this is important. Unlike many of those pre-revenue startups back in 2000, today's Magnificent Seven are generally highly profitable, cash-generating giants. That fundamental difference could make them more resilient this time around.
So not a perfect parallel. Any other echoes?
Well, you see echoes of 2008 in the stress building in commercial real estate and the risk to banks. And maybe even 1987, the Black Monday crash, which was more of a technical market structure event driven by automated trading. You could argue there are parallels there with today's complex algo-driven markets.
Okay, history rhymes. But we always need to challenge assumptions. What are the strongest arguments against this bearish outlook? Why might things turn out okay?
Good question. It's crucial to consider the bull case. First, just the remarkable resilience of the U.S. economy itself. The labor market, consumer spending, they've defied pessimistic forecasts again and again over the last couple of years. Maybe they continue to do so.
Keep chugging along.
Right. Second, the AI productivity boom. What if it does arrive sooner and stronger than expected? That could unleash huge economic growth, boost corporate earnings massively, and actually validate some of these high valuations.
The optimistic AI scenario.
Exactly. Third, there's always the Fed put, this deep-seated belief in the market that the Federal Reserve won't let things completely fall apart, that they'll step in with rate cuts, maybe even QE again, to stop a catastrophic collapse.
The Fed cavalry riding to the rescue.
That's the belief. And finally, related to that, the precedent of a soft landing. The Fed has managed to cool the economy without crashing it before, like in 1994-95. Maybe they can thread that needle again. It's not impossible.
So a complex picture with arguments on both sides. Given all this, what does it mean for you, the listener? How can you stay informed and, importantly, prepared?
Look, these aren't specific investment recommendations, obviously. It's about risk awareness and being strategically prepared for different outcomes.
Makes sense. What's the first step?
First, conduct rigorous stress testing on your own portfolio. Seriously, model what might happen. Ask yourself, what's the impact if the market drops 25%? What if it's 40%? How does that affect my financial goals? Knowing your vulnerabilities is key.
Okay, know thyself, know thy portfolio. What else?
Second, reevaluate your diversification. With so much concentration in U.S. mega-cap tech, is your portfolio overly reliant on just a few winners? Maybe consider things like equal-weighted indices or looking more at international markets or even alternative assets to spread the risk.
Don't put all your eggs in the Magnificent Seven basket.
Pretty much. Third, prioritize liquidity and credit quality. In your bond allocation, maybe shift towards higher-rated corporate bonds or safer U.S. Treasuries. And crucially, maintain some dry powder, keep some cash accessible. If markets do correct sharply, having cash allows you to potentially take advantage of lower prices.
Be ready for opportunities. And fourth,
Maybe monitor hedging costs and effectiveness. Tools like options, specifically protective puts, can help limit downside risk. But you need to understand them, and crucially, that window to hedge effectively can close really fast if volatility suddenly spikes. They can get expensive quickly.
So understand the tools and the timing. Are there specific numbers people should watch, key metrics?
Yes, the analysis provides some action triggers, specific levels, and key indicators that could signal escalating risk. For instance, the high yield spread, OAS, we talked about. It's currently low, around 2.86%.
Right.
Watch for a move above 600 basis points, or 6%. That often signals a recession is likely underway. If it spikes towards 900 basis points, or 9%, that usually means severe market panic.
Okay, so watch the corporate fear gauge. What else?
The VIX index, the market's main fear index, it's around 20 now. A sustained move above 35 signals high fear. If it gets above 50, that often points to systemic deleveraging, forced selling.
Got it. VIX above 35 or 50.
Then the 10-year Treasury yield, currently around 4.23%. A disorderly spike above 5.5% would really tighten financial conditions everywhere. A move above 6.5% could signal a loss of confidence in U.S. fiscal stability, a really serious development.
Watch for bond yields getting out of control. And lastly, the CRE risk.
Yes, specifically the CMBS delinquency rate for the office sector. It's already at 12.1%. If that surges above 15%, expect material impacts on bank balance sheets. If it hits 20% or more, you're likely looking at severe stress for regional banks.
Okay, those are concrete numbers to track. OAS, VIX, 10-year yield, and office CMBS delinquencies.
Exactly. They can provide real-time clues about how these risks are evolving.
So wrapping this all up, what's the biggest takeaway for you from this deep dive? It feels like we're navigating a minefield.
I think for me, the key takeaway is just the sheer number of different serious risks that are all present at the same time. It's not just one thing. It's valuations and recession signals and policy risks and market structure issues and external factors like tariffs. It's the combination.
The confluence of risks.
Precisely. It makes the situation feel particularly precarious. The question feels less like if we'll see a downturn and more like when and how severe it might be.
Which leads to our final thought for you today. In a world where so many indicators are flashing red, yet the market seems to defy simple predictions day to day, how can staying truly informed not just about the headlines, but about these underlying dynamics? How can that not just protect your finances, but actually empower your decision-making in what's clearly an increasingly complex global economy?
It's not about having a crystal ball.
No. It's about understanding the odds, understanding the risks, so you can make smarter choices today for whatever tomorrow brings.